In this episode, we will discuss how loss aversion, the tendency for losses to have a greater psychological impact than gains, may lead investors to retain or increase their positions in asset bubbles as indicators of instability emerge. We'll also cover how macroeconomic downturns or interest rate increases can cause potential losses to become realized. Loss aversion refers to the tendency for individuals to experience losses with twice the intensity versus gains. Within bubbles, investors who have entered a position often find it difficult to sell when prices begin to decline, as doing so would require them to realize a loss or acknowledge an error in judgment. So they may retain their holdings or even increase their investment through, quote, averaging down in anticipation of a market recovery. This behavior can result in investors becoming, quote, bagholders, retaining assets as their values diminish significantly. A related behavioral bias is anchoring, where investors become fixed on a previously higher price point and are reluctant to divest at a lower value. U.S. equity price movements during the 1920s and 1930s exemplified a classic bubble cycle. Throughout the 20s, the U.S. economy experienced significant growth, largely propelled by the industrial innovation resulting from the Industrial Revolution. During this period, minimal financial regulation allowed investors to purchase stocks on margin with as little as 10% down. Consequently, the equity market, represented here in blue, appreciated by more than 200% in the latter half of the decade as investors piled into stocks with borrowed money. Toward the end of the 1920s, the Federal Reserve began to increase interest rates, depicted in white, to moderate the rapidly expanding economy. As a result, equities declined by nearly 50% between August and December 1929. Despite this abrupt correction, the stock market rebounded over 20% through March 1930, providing optimism for investors hoping to recover earlier losses. The strategy failed. As interest rates increased further, economic activity slowed and equities continued to decline, eventually falling by 85% over the following 2 years, as margin calls prompted investors to sell stocks to meet collateral requirements or close their position. This selling pressure accelerated declines, resulting in significant losses for many investors as they were left holding the bag. Human nature makes us hate losses far more than we love gains. In a bubble's decline, this leads to denial. Investors hold losing positions too long to avoid the pain of selling at a loss. They might even double down, turning temporary downturns into disastrous outcomes for themselves. But when macro conditions worsen, say a recession hits or interest rates rise, even the staunchest believers may finally panic sell, worsening the crash. Understanding loss aversion explains why bubbles don't deflate gently. They burst dramatically when enough people can't take the pain anymore. Thank you for your time today. Please join us for our next episode, where we will discuss the hype machine, narratives, and the impact of social media.